Hello friends, I am Ganesh Kamath and welcome to Simply Speaking. In this video, I will try to share 5 of the most common biases that can influence investment decisions and impact investors like you and me. Investment is not just about higher returns or fund ranking. Your investment journey is also about your emotions that can be either your greatest friend or your worst enemy. By understanding these critical biases, we can learn to navigate the market volatility better and perhaps make smarter investment choices. So let's dive into understanding each of these biases in brief. Daniel Boorstin, an American historian, states, "The greatest enemy of knowledge is not ignorance, it is the illusion of knowledge." This illusion of knowledge makes us vulnerable to one of the most common biases in investing, that is confirmation bias. Now, let us say you wanted to buy a stock of a particular export-oriented company and you started researching about it. You saw that stock has been doing well for the past few months and therefore you now start looking out for positive information about the company's growth prospects, which then confirms your belief of investing in this stock. Your excitement builds in and you start adding this stock in your portfolio. But here is the catch. Confirmation bias has sneaked in and has influenced your decision-making process, and you didn't even realize it. Unfortunately, a few months later, due to a possible recession in Europe, this stock suddenly starts falling, where the company has a major market share. And guess what? Due to projected underperformance in the company's growth, you decide to sell your holdings in the company at a loss. This incidence reflects your confirmation bias that clouds your investing decision and impacting long-term returns in your portfolio. Thus, to overcome confirmation bias, you should consider all the facts and information around the investment, even if it contradicts your original investment ideas. We should rather approach our investment opportunity with an open mind and a willingness to learn, and you will do well on your way to achieving your financial goals. Have you ever noticed how our minds tend to prioritize information that is fresh in our memory? We tend to get influenced with the recent events and information. This tendency reflects our recency bias in making decisions. We all want to make money and are looking for the next big opportunity to invest. Imagine you came across the best performing sectoral mutual fund that has outperformed other diversified equity funds via wide margin. The fund's one-year performance that you saw in one of the advertisements portrayed an impressive opportunity and caught your attention. Driven by the excitement of these recent gains, you may feel tempted to invest in the fund, assuming that its exceptional performance will continue in the future. This is a classic example of recency bias at play. However, after you examine the fund's performance over an extended period, it being a sectoral fund, you see that its performance is more cyclical in nature with periods of underperformance and volatility. Over time, you realize that this investment doesn't fit in your risk profile and time horizon. By solely focusing on the fund's short-term gains, we overlook important factors such as the fund's investment strategy, asset allocation, performance consistency, diversification, and so on. This way, we should consider some of these factors which can help us to avoid the pitfalls of recency bias. How many of you have ever made your investment decisions based on your past experiences? I am referring to a popular bias known as anchoring bias that influences our thought process. For instance, you might have developed a perception based on your past experience that whenever the markets rally over a period of time, significant decline is bound to happen. Let me throw a numerical example at you. Suppose you started your SIP of Rs 10,000 on January 1st, 2020, when Nifty 50 was at 17,100 levels, and it reaches its highest level on January 14th, 2020. Then there is a crash on 23rd March due to COVID pandemic. You hold on to your SIPs and continue till November 6, 2020. This is the day when Nifty 50 again reaches its previous high that you witnessed on January 14, 2020. During November, markets starts looking expensive to you and therefore you stop your future SIPs from December onwards, perhaps waiting for another crash. You keep on holding your SIP amounts in cash at a meager growth of 4% as you assume that the markets have peaked and wait for a fall to start your SIPs again. By pausing your SIP and holding cash, you make a CAGR return of over 13% on your total portfolio. However, if you had continued your SIP without thinking of timing the market, you would have earned a CAGR return of over 16% on your total portfolio. That's a massive alpha of 3% on compounded basis. Over time, the markets continued to rise, breaking new records despite global volatility and other macro factors. Thus, by stopping your monthly SIPs, you failed to adjust your anchored belief and align with the evolving market conditions. This example highlights how anchoring to your past events or beliefs can limit your ability to make rational decisions and miss out on potential opportunities needed to achieve your financial goals. It is said that the pain of losing money often outweighs the joy of making it. And that takes me to another common bias which perhaps is ingrained in the human mind, the loss aversion bias. Let me quote you a scenario where you have been an investor into a diversified equity mutual fund, which invests into a high conviction portfolio of maximum 30 stocks. The fund has a strong consistent performance track record which convinced you to stay invested for a long period. The fund manager, with his expertise of managing the fund, tends to diversify by investing in an international stock, which gradually stops performing in his favor, thus affecting the overall performance of the fund. As expected, the NAV slides downward and starts underperforming peers within the category. This underperformance influences us to overreact, often leading us to make irrational decisions. You become overly cautious and fail to objectively evaluate the long-term potential of the investment. You may be hesitant to hold on to this fund or even consider selling it at a loss to avoid experiencing further pain. This is what is known as loss aversion bias. Now let's fast forward and imagine that the same mutual fund investment eventually recovers and outperforms the category and benchmark by a wide margin. If you had redeemed your investment earlier, then you would have missed out on the fund's potential of generating higher returns. So, to navigate the emotional challenges associated with the loss aversion bias, it is very important to hold on to your investments by ignoring short-term fluctuations and set realistic expectations from your investments. Look around you and you will notice many instances where we have the habit of imitating. It may be in the form of latest fashion trend that you wish to imitate from your famous celebrity, a latest mobile handset, copying your friend's recent purchase, or following your parents' advice of investing your money in a traditional asset class without even considering other investment options. Herd behavior, also known as herd bias, refers to the tendency of the investors to copy and get influenced by the actions and decisions of a larger or influential group without proper self-analysis. Winners keep rotating. This holds true when it comes to the performance of various asset classes. Imagine a situation where you are struggling to identify the right investment opportunity due to the inherent volatility in the performance across the asset class. Meanwhile, a good friend of yours suggests you to invest in a particular asset class which he has invested in with an expectation of linear growth in the coming year. This could be triggered by a media hype, market trends, or a collective behavior of investors following the herd. The excitement and buzz around the asset class can be contagious, leading you to feel the fear of missing out and prompting you to invest in the same asset class. After a year, you witness that your entire capital gets eroded by relying solely on the actions of the crowd, leading to suboptimal investment decisions. When you are confused in identifying the right investment opportunity, one effective approach to mitigate herd behavior is through a multi-asset allocation strategy. Instead of chasing the latest investment trends, this strategy aligns the portfolio to changing market conditions across various asset classes based on the fund manager outlook. This way, it can reduce volatility associated with exposure to a single asset class, give you benefits of diversification, and capitalize on opportunities of growth potential. Remember, investment bias is inversely proportional to your investment success. By now, you must have understood that fighting with our inner biases is an ongoing journey in the pursuit of successful investing. But being aware of these common biases can help mitigate their influence on you and help you with a better decision making in all aspects of your life, including your investment decisions. Thanks for watching and happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.